The biggest risk to your FIRE plan is not investing, it's withdrawing. I know, we spend all this time obsessing over picking the right index funds or catching the next big tech rally, but honestly, the withdrawal phase is where the real danger lives.
Think about it. Forced selling during a sudden market drop is absolutely one of the fastest ways to just completely destroy a perfectly good FIRE portfolio. It is the silent killer of wealth, and it catches so many early retirees completely off guard.
Now, before we dive into how to actually prevent that nightmare scenario from happening to you, just a really quick note. This explainer is strictly for educational purposes, so please don't take it as financial advice. Okay, let's set the stage. Imagine you finally reached the finish line. You put in the hard work, you've officially retired, and you're sitting on a fully invested $1 million portfolio. It's mostly in stocks, index funds, maybe some bonds. You are feeling absolutely great about your financial future. And then, bam, the market suddenly drops by 25%. We've all seen this happen in the news, right? But watching a quarter of your own actual life savings just evaporate, that brings up a very real, visceral panic. It is terrifying when your net worth plummets overnight. But here's the real kicker. Even in a deeply down market, your life doesn't pause. Your expenses definitely don't stop. You still need, say, $40,000 to cover this year's living expenses. The mortgage still has to be paid. You still got to buy groceries. The lights have to stay on. So, what happens when you're forced to sell off investments to get that 40 grand right when market prices have plummeted? Well, you're locking in a permanent loss. You're literally causing mathematical damage to your wealth because those shares are gone forever. They won't be sitting there in your account to recover when the market eventually bounces back.
So what do you actually do? Now, you could try to rely on strict percentage withdrawal rules, or maybe set up some flexible guardrails, or even try adjusting your income mix on the fly. But let's be real, when you're staring down a massive market crash and that panic sets in, complex math rarely helps. How do you actually survive without cannibalizing your portfolio?
This is where we introduce a brilliantly effective solution known as the bucket strategy. It's a super simple, intuitive approach where you completely separate your money based entirely on the timeline of when you actually need to spend it. We're going to divide everything into 3 distinct categories: now, later, and much later. Your short-term now bucket is essentially your immediate safety cushion. This holds cash or very safe, highly liquid assets that are designed to cover about 1 to 3 years of living expenses. So going back to our example, if your life cost $40,000 a year, this cushion might hold anywhere from $80,000 to $120,000 in pure, highly accessible cash. And here is the crucial point. When the market inevitably takes a nosedive, you don't even look at your stock portfolio. You don't touch it at all. You simply live directly out of this cash cushion. That means absolutely no panic selling. It completely removes the stress of checking the daily market ticker because, hey, your immediate future is already fully paid for. Backing up that cash is your medium-term money, the later phase. This is typically held in bonds or slightly more conservative, stable investments. Its entire job is to just act as a reliable refill mechanism. So as those volatile stock markets naturally recover over time, you slowly move money from this stable bucket forward to replenish your short-term cash. Which leaves the heavy lifter, the much later phase. This bucket is entirely dedicated to long-term growth. We're talking broadly diversified stocks and index funds. This is the main engine that keeps your overall portfolio alive, compounding for decades to come, and making sure you're far outpacing inflation. By completely separating your wealth based on time, you're fundamentally changing your relationship with your money. Instead of looking at one massive, intimidating pile and reacting emotionally to its wild daily swings, every single dollar now has a specific job, a specific location, and a specific timeline. You see, the absolute worst financial damage almost always happens when people mix these timelines up, like when they treat highly volatile, long-term investments like a short-term checking account. Maintaining this strict, time-based discipline actively prevents that catastrophic error from ever happening. Now, here's a really important perspective shift that we need to talk about. The bucket strategy is not designed to maximize your returns. It's just not going to make you richer overnight. Its true power, its entire purpose, is in reducing your overall risk and drastically lowering your psychological stress. It prioritizes the survival of your portfolio over trying to squeeze out every last drop of yield. Because ultimately, FIRE is not just about the math on a spreadsheet. It is entirely about behavior.
The long-term success of your early retirement really relies on your ability to stay incredibly calm when the financial world around you seems to be falling apart.
At the end of the day, the absolute best way to protect your long-term wealth isn't by predicting the next hot stock or trying to time the market perfectly. It's by intentionally preventing costly emotional mistakes. Running out of money is the biggest emotional fear we all face, and that structured, time-based discipline is your ultimate armor against market volatility.
So I want to leave you with this one thought to consider today. When you look at your own FIRE portfolio right now, are your investments just organized by the asset type, or are they actually organized by time?